Rohr here with an early global view on Thursday, October 16th, 2014. It's currently 6:30 a.m. U.S. Central Time. After another wild and woolly day on Wednesday, that's beginning much the same on Thursday. And of course, that's because of the many macro factors that are impacting the markets in both directions. And speaking of how the markets are responding to all this, it's very important to note initially that the bigger support that we had highlighted below 1850 to 45, which of course was violated right on the opening yesterday. That's after the failure up at the 1885 area, which the market held early Monday, knocked out later in the day, and could not really stage a sustained recovery back above on Tuesday. That remains an important level, also because of the false upbreak out of the, at the time, aggressive downward channel on the hourly chart right here at about 1882. And what we have is the failure below 1845 to 50 that saw a bounce early and then a recovery late, but not any real sustained activity back above it. Market finishing off back around 1845, not breaking out on the channel on the hourly chart, and even though it had broken out temporarily out of the channel on the 30-minute chart. This is the aggressive down channel, overall down channel since the last rally high up to 1970 last week. As you can see on the left-hand hourly chart, it did break out from right around 1851 on the 30-minute chart. It was already fading back below it. And that set the stage for today's early activity, where the S&P is already off about $20 on the day on these further macro concerns. You know, the Ebola, Eastern Europe, Middle East, for lack of a better term, lack of effectiveness of the U.S. government, in addition to all of the weak data out of Europe and recent German recalcitrance on any kind of massive QE from the ECB. However, you'll notice how quickly the market sank below 1845 to 50, all the way down to a low at 1814. And interestingly enough, the upward channel we'll see on the intermediate term chart, the weekly chart, is 1810 this week. It moves up to about 1814 next week, 1415. And of course, there's going to be psychological support around the proverbial big penny, around 1800. And those are basically the levels. You know, you're dealing with not much between 1850 to 45 and 1810. And as far as the indicators, it's interesting to note that even though it tried to clean up on Tuesday for a little while, the market gap lower yesterday ensured that the weakening off of the 30-minute MACD back below its lower runaway band was, sustained. And even on the recovery for the entire second half of the day yesterday, after the market hit lows into lunchtime, it never got back above its lower runaway band. And of course, the more important hourly MACD has continued to remain weak below its lower runaway band. It dropped below all the way back on last Thursday on the post FOMC minutes release rally, faded at that time. And that's pretty much it for the short-term view of the S&P 500.